Hi, I'm Andrew Berman with the Mortgage News Network. We're here in Atlantic City at the Northeast Conference of Mortgage Brokers and Professionals. Sitting with me today is Peter Boockvar of Bookmark Advisors. Peter, listen, I want to get right into this. You did a great presentation today, talking about the economy. Where do you feel that interest rates are going to go from today, where we're standing?
Well, I think the July lows in interest rates, which came right after the UK voted to leave the EU, which led to this stampede into treasuries, and we saw a big drop in interest rates. That was the low that we're going to see possibly in our lifetime. And we've seen this upward trajectory since then that I think will continue. And it didn't just stem from here. It started in Japan, went to Europe, went to the UK, it came to the US. So I think this is a beginning of a longer-term trend where interest rates are going to head higher. Central banks are going to be less influential in suppressing interest rates. We're going to start to see some higher inflation. We're going to see also higher deficits and further increases in debt that are going to be less tolerable on the part of investors. So again, interest rates are headed higher from here, and we may never see the July lows again.
All right, so now let's talk about that. What is the net effect on housing? Because first off, most people in the mortgage business, they've never seen rates much higher than they are right now. I mean, if you've been in the business for longer than a decade, you've seen rates in sevens, eights, and the people that are in the business today, they can't fathom how they could do business that way. What's going to happen? What's the net effect on housing?
Right, there's not many people in the business that saw in 1981 when the 10-year bond yield was almost 16%. Then it fell to 1.38% in July. So you're right, they're not used to it, but I think that they should grab what they can now in terms of low rates and understand that rates actually have gone up in the past. We have long stretches of bear markets in bonds if they go back to the history books. I don't know the pace of the increases from here because there are a lot of offsets in terms of slow growth, but I think as a starting point, people should acknowledge that rates aren't going any lower. And if someone's going to wait to try to grab a few extra basis points in lower yield, don't bother, because it's not going to get better from here, and get it while they go higher from here.
So when the rates go high, when they're at where, I don't know where they can go, but I mean, what's that high point, and will it have a damaging effect on housing in a significant way?
All right, so to quantify, in the beginning of the year, the 10-year bond yields, which obviously mortgage rates are priced off, were 2.25%.
Yeah. Right
now we're 175, so we can easily rise another 50 basis points in a rather short period of time. So I would consider that as a short-term ceiling that is potentially realistic. What that means for housing, well, we've seen 5 to 6% increases annually in home prices. The offset to that for the buyer was very low interest rates. While you throw on a 50 basis point increase from here in mortgage rates, well, they'll be less tolerant of those 5 to 6% type price increases. So they'll be more inclined to rent instead of buy. So price increases, so the offset is price increases may slow down if mortgage rates go up. So whatever people lose in terms of having to pay a higher monthly payment, maybe they'll get back in terms of lower home prices. So the real risk may be to home sellers rather than to home buyers if interest rates go higher.
So the affordability is going to be happening not through a lower payment from interest rates. It's going to be happening through pressure on prices. Volume-wise, do you think could we see 50% of the volume that we're seeing now? I mean, could it go that low in terms of overall mortgage volume?
Well, that's a tough call. At least on the refi side, refis will evaporate, of course. I mean, they're already down dramatically over the last couple of years. I mean, if you haven't refied now, I don't know what you're waiting for. So that will basically be shut down. But housing has a long way to go just to get back to its long-term average. Single-family housing starts came out today and did show a nice increase, but they're still more than 20% below their 25-year average. Now, that's a reflection of the aftermath of a popped bubble, but on the other hand, it shows that there's a lot of catch-up to do over the next couple of years.
Understandable. So listen, I mean, I don't think we could have a conversation, today, considering actually that within months we're gonna have a new president. If we have Clinton or if we have Trump, is there any difference, or is there going to be any actually impact on rates or housing with either candidate?
They're each going to face the same challenge. That is, the economic expansion is long in the tooth. They're likely going to preside over the next recession. They're likely going to preside over the next bear market. That's going to impact housing. That's going to impact interest rates, regardless of who the next president is. Now, granted, both of them will attack those challenges in different ways, but I don't think it changes the inevitable outcome of a rise in interest rates, of a recession, and of a bear market in stocks.
Great. So listen, I mean, from what you're saying, it sounds like this is an amazing time to do as many loans as you possibly can, get your borrowers off the fences. This is not the time to think about things. This is the time to take action.
Yes, don't try to save an extra 5 or 10 basis points because you may not get it. And if you look at what the potential upside is in rates relative to the downside, I think people should lock right now.
Fantastic. Appreciate that, Peter. Thank you for taking the time any day. And I'm Andrew Berman for the Mortgage News Network. Thank you for watching.
This is Mortgage News Network.